It's John Observation here. What we've just witnessed overnight is one of the most violent and revealing price moves we've seen in years. This was not a normal pullback. This was not healthy consolidation. This was a full-scale liquidation event, and it smashed through silver and gold with shocking force before triggering an equally aggressive bounce. Silver collapsed all the way down to $71 per ounce, flushing out leveraged positions across the board. Gold dropped hard as well, falling to just under 4,400 before snapping back. And then, almost as fast as the sell-off came, we saw a massive rebound. As I'm recording this pre-market, silver has already recovered from $71 to $83, which represents a 17% bounce off the lows. Gold has clawed back roughly $250 of the $450 it lost during the panic. From the intraday low, gold is now up about 7%, while silver has surged roughly 15%. That kind of move is not normal. That kind of volatility tells you the system is under stress. And now, all eyes are on the New York session, because that is where we find out whether this bounce is real or whether it is just another trap before the next leg down. In my previous videos, I laid out very specific scenarios for silver, and I made it clear that Bitcoin was the key leading indicator to watch. There's a reason for that. When large-scale risk sentiment shifts hit global markets, crypto, especially Bitcoin, almost always moves first. It acts like a pressure sensor for the entire financial system. When liquidity tightens or fear rises, Bitcoin reacts before traditional assets do. That gives us a critical early warning for what's coming next in markets like silver and gold. I told you directly that the most important level to watch was whether Bitcoin closed the weekend above or below the 80 to 82,000 range. I said clearly that if Bitcoin closed below that zone, we should expect selling pressure to spread into other risk assets. Bitcoin didn't just close below it. It collapsed to 76,000 with an intraday low of 74,500. I also warned that a test of 74,000 or lower would confirm serious weakness and validate the bearish scenario. That is exactly what happened. This was the cornerstone of my bearish thesis, and the spillover selling unfolded exactly as expected. Silver was hit hard, crashing to $71 before staging the relief bounce we're seeing now. The question is whether New York confirms this bounce or whether the bearish scenario resumes. I want to take a moment to acknowledge everyone who commented on the last video. I read every single one. What stood out to me wasn't confusion. It was preparedness. Some of you are bracing for another leg down. Others are firmly committed to the long-term macro thesis for precious metals. That divide doesn't mean people are lost. It means people are thinking independently and executing their own plans. That's exactly what this channel is about. We are not here to sell fear, greed, or Netflix-style hype about instant riches. This is not a scripted show with a guaranteed happy ending. These are real markets with real risk. Independent thinking matters more now than ever. Let me make something absolutely clear, especially for anyone new here. I do not sell signals. I do not sell courses. I do not offer mentorships or paid services. Anyone claiming otherwise is lying and scamming you. Block them immediately. My only role is to provide an unfiltered, real-time view of what is happening in the markets. I operate solely on X and YouTube under the handle erogjohnag. Those are the only platforms where my analysis exists. I will never ask you for money. Protect yourself. Now let's talk about the data as it stands right now in pre-market. Shanghai spot silver is trading at $11.99. SHFE futures are around $11.42. Western spot prices are sitting near $83.47, with Western futures matching that level. That creates a premium of roughly $18.52, or about 22%. This is down from the 43% premium we saw over the weekend. But let's be clear, 22 to 23% is still extreme. That premium alone tells you something is deeply wrong beneath the surface. Volatility is off the charts, and again, we are waiting for New York to open to see which side breaks. Zooming out, the scale of destruction over the past 3 days is staggering. Roughly $10 trillion in market value has been wiped out. Gold is down about 20% from its peak, erasing approximately $7.4 trillion in value, 5 times the entire market capitalization of Bitcoin. Silver crashed nearly 40%, wiping out about $2.7 trillion, which is roughly equal to the entire crypto market. So-called safe haven assets are moving like meme coins. This is not normal behavior. This is the continuation of the Kevin Walsh Fed chair sell-off, but with a twist that makes this event fundamentally different from a typical crash. Here's what did not happen. Central banks did not dump their gold. Tether did not sell its gold. The US government did not suddenly solve its debt problem. In fact, the US government shut down because it cannot get its spending under control. So why is gold being sold so aggressively? There is a clear disconnect between different gold markets, and the most logical explanation is that someone desperately needs liquidity. That means gold and silver are being sold not because their fundamentals changed, but because they are among the most liquid and profitable assets available. When margin calls hit, funds don't sell what they want to sell. They sell what they can sell. Gold and silver become the piggy banks that get smashed first. This is classic liquidity crisis behavior, and historically, when gold is sold like this, it often signals that something is about to break elsewhere in the system. Now here is the smoking gun that proves this is paper-driven manipulation, not a collapse in physical demand. In Singapore and Australia, people are lining up to buy gold, while silver is broadly sold out. In Hong Kong and China, queues aren't even forming, not because demand is weak, but because supply is scarce and premiums are too wide. In Europe, dealers have pulled their silver offers entirely. Even as prices plunged, people in Singapore continued queuing to buy gold. That is extraordinary. Retail demand for physical metals is not breaking, it's strengthening, and the numbers confirm it. One of the world's largest private silver vaults, the Reserve in Singapore, reported increased physical silver demand during last week's crash. They see a growing divergence between paper and physical markets and expect shortages to worsen. On China's largest e-commerce platform, JD.com, silver is currently priced at around $163 per ounce. COMEX is sitting near 83. That's a 95% premium. Let that sink in. 95%. And silver is still in backwardation. You cannot fix a massive physical shortage by smashing the paper price. This manipulation is about preventing a Western financial crisis, not reflecting real supply and demand. Whatever is happening behind closed doors is big, and it's dangerous. Silver remaining in backwardation means there is a genuine shortage of physical metal. Shorts will eventually have to deliver. They are playing an extremely risky game. We are in the middle of a precious metals revaluation process, where COMEX and LBMA vaults are being drained, especially silver. At the end of this process, the full revaluation will emerge, and silver will trade dramatically higher, likely driving the gold-to-silver ratio toward 15-1. What's especially telling is the behavior of futures volume. Yes, prices were smashed last week, but overall, volumes remain surprisingly balanced outside of large dump events. That suggests the price is being forced lower through spoofing, overnight trading, and wash trades during US hours. This artificial pressure triggered derivatives unwinding in ETFs like SLV and AGQ, flushing stops and accelerating the move. None of this reflects the physical market, where fundamentals remain unchanged and shortages continue to worsen. Now let's talk about what New York could bring. There are 2 clear scenarios. The bearish case is that selling resumes, silver retests 71 or breaks lower, and the bounce proves to be nothing more than a relief rally. CME margin hikes take effect today, and if traders can't meet them, forced liquidation continues. Bitcoin already confirmed weakness. If it breaks lower, risk-off sentiment spreads everywhere. Add to that the reality that $9.6 trillion in U.S. government debt matures over the next 12 months, the most in history, and must be refinanced at much higher rates. This is systemic stress. The everything bubble is deflating in real time, and in deflationary crashes, metals often get dragged down initially. But there is also a bullish case. If the bounce from 71 holds and New York builds on it, silver could reclaim 87 or higher. Sharp drops are designed to trigger fear and shake out weak hands. The macro backdrop has not changed. Debt, deficits, geopolitical tension, and monetary instability are all still here. Silver is historically undervalued. The gold-to-silver ratio sits near 57:1 versus a historical norm of 15:1. Vault ratios, mining ratios, and above-ground supply all point to massive mispricing. When fundamentals regain control, silver doesn't creep higher. It explodes. So what am I watching? Does the bounce hold? Does Bitcoin stabilize or break lower? Do equities drag metals down or do metals decouple? Does the Shanghai premium hold or expand? Do we get news on bank stress, government shutdowns, or geopolitical flashpoints? The answers will come quickly. Where does this leave us? Physical and paper markets are completely disconnected. Physical demand is strong. Paper markets are under stress. History tells us paper breaks first. New York will tell us whether 71 was the bottom or just a pause. This is extreme volatility, and leverage here is exceptionally dangerous. Think for yourself. Use your own judgment. Do not follow blindly. This is real risk. Stay sharp. Watch the data. Invest with logic, not hype.